All right, I'm Tom Sosnoff. He's Tony Batista. It's 8:16. This is a piece we put together. Our research team put this together on correlations. You know, when markets go down, there's almost no place to hide. So market storms and portfolio correlations. Where do you hide when markets go lower and everything moves to a correlation of 1? There's a common saying in financial markets that during crashes or sharp down moves, all correlations go to 1. This implies that diversification, the benefits of diversification diminish when you need them the most. So what does the actual delta tell us? Is this true? And you know damn well it's true. Question is,
of course,
how do you get around it? Which I don't even know the answer to that, because when things get ugly, as you've seen before, yeah, I mean, the concept of diversification, it's a toughie. Let's go next slide. But the more we know, the better we can address it. When we look at the long-term data, we find that Apple and SPY typically show a correlation of about 0.61, a moderate positive relationship. However, after the market pullback beginning on April 2nd, the correlation jumped to 0.86, showing an extremely strong correlation during market stress. Yes, what that means is that when the market went down big, Apple and the SPY, the correlation between those two increased by almost 50%.
Right.
That's a big number. One practical approach to measuring market stress is examining VIX levels. If our hypothesis is correct, then we should observe stronger correlations between assets like Apple and SPY during periods of elevated VIX. And the answer is, of course, you should. Let's go to the next slide. And you're going to see that. So here, the data confirms our hypothesis. We clearly see correlation spikes between SPY and Apple during major market downturns over the last 2 decades. We did this for 20 years. The chart pattern shows distinct periods where the correlation strengthens precisely during market stress, when the market's stressed. And you can see this here. Every time the market got stressed, Apple and the SPY together both got killed.
Sure, which you would expect.
And they got killed, kind of the same way. Let's go to the next slide. Perfect. So looking at the hard numbers, the data reveals systematic pattern. This progressive increase confirms that asset correlation strengthens as the market volatility increases. So you can see VIX level above 20, Apple SPY 50, above 30, 65, above 40, 80. Obviously, if it goes above 40, above 50, it's probably 88, whatever it was. So, yeah, crazy moves. And
yes,
the higher the VIX goes, the higher the correlation goes. To ensure that our findings aren't limited just to tech stocks, we expanded our analysis across diverse sectors, including Southwest Airlines, the emerging markets, Apple, XLE, which is an oil producers, and Costco. Let's go to the next slide. So we kind of jumped through everything in there, everybody in the pool. And then what we looked at was the correlation against the SPY. What we found is that VIX 20, 30, and 40 and above, the correlations for all of these against the SPY go up dramatically. Love goes up by 50%. EM goes up by a little less, by about 20%. Apple goes up by 20%. XLE goes up by almost 25%. Costco goes up by 20%. And so there's a huge jump in the relationship between these stocks and the SPY when the market goes down, showing that correlation is so important, because even if you have a perfectly highly correlated position on, it's hard to protect the position. Let's go. The average just goes to 0.84 from 0.66. Sure. So when you think about that, 0.84 from 0.66, it's just about 25% in that range. So takeaways.
And the correlations are pretty strong, which you would think, right? I mean,
it's a good, straightforward piece.
Right. It's been the elusive, how to get uncorrelated in a correlated market, right? I mean, that's been
what they should show on the next time we do this kind of a piece. They should show it against different futures, because that'll have maybe a greater correlation, maybe not, but just a little bit better. I mean, I'm sorry, they'll be a little more non-correlated, which is what we want to show. During significant
Right.
market declines, assets that normally display moderate correlations tend to move in the same direction. Traditional diversification strategies become significantly less effective when market volatility spikes, and risk management during high volatility periods may require reducing overall market exposure rather than relying on diversification. I think that futures diversification is a big plus in this case, but this is all equities.
Understood, but you're going to get a lot of pure delta from a futures
Yep.
point of view, right?
No question.